Dan Ives of Wedbush Securities and Vance Howard of Howard Capital Management recently joined CNBC to discuss why Wall Street won't stop buying AI, why AI demand and Nvidia momentum continue to support this market despite ongoing concerns around interest rates and inflation. According to Dan Ives, every dip in this market continues to get bought, as Wall Street remains heavily committed to the AI trade and the broader technology sector. In this video, I will show you the full clip of Dan Ives' interview, then break down exactly what he means and share my own reaction and analysis. After that, I will walk you through 2 AI stocks under $10 that could offer long-term growth potential. Let's get into what Dan Ives had to say.
Dan, I'm going to kick this one off with you. We just showed that chart of 30-year treasury yields versus QQQs. Are we overstretched here in terms of this AI tech trade and just how far it's run, how quickly?
Look, that's why it's so important in terms of Nvidia earnings, because I think that's going to put just more fuel in this tech rally. You know, we think tech stocks are up another 10, 12% rest of the year. Look, we're going to have some of these white knuckle moments, you know, whether it was Iran, whether it's rates, especially wars coming in, but it just continues to be the risk-on trade because this fourth industrial revolution, like we said, it's top of the third inning, one out, and that's where we are. And I think you're going to continue to see these dips get bought.
Why do you say especially with wars coming in?
Because I think there's just worries, you know, him coming in, what does it mean for tightening, you know, worries about rates. If you look at just like when any time a chairman comes in, what the stocks do over the next 3 to 6 months. So there's definitely nervousness. The bears will come a little out of hibernation mode, and you'll see them scare some of the bulls. But the reality is that we are still early in this trade in terms of AI. We'll hear from Godfather of AI this week, and that's going to be just another important data point in what we see as this plays out.
You have the best nicknames for all these different companies and CEOs. Vance, want to get your thoughts on this, especially given the fact that if you do look at some of the technicals, we are looking, at least within the equity markets, with oil higher, with rates having this big run up, overstretched.
Yeah, it is in the short term, but I agree with Dan. You know, I think it's sort of a white knuckle moment where it kind of gives you a little bit of pause. But, you know, just move your stops up a little bit. I think you need to be a little bit nimble. But I think Dan's spot on. I think the market's going to go higher. I think he's right that, you know, the tech trade is still very much alive, and I think any pullback is viable. You know, our target was 7,800 on the S&P. It looks like we're going to get there by midsummer, and you know, 8,000 is in the sights.
How would you be playing the tech trade right now, Vance?
I would be nimble, but I would be long tech. I'm very bullish on it, and I can't see tech going. You know, I think we're going to get a pullback here, maybe 3 to 5%, which would actually be a gift. It would give us a chance to add to some positions that we like, put some capital to work that maybe we've been sitting on cash just a small amount, and I think it'd be a good chance to take the opportunity to buy some great equities.
I do want to dig a little more deeply. Yeah. Oh, go ahead. Looks like you're ready to go.
No,
here.
But I was going to say, I think Vance makes phenomenal points in terms of these dips get bought. Look what we saw in March.
Yeah.
Tech.
Speaking of Nvidia, wow, talk about a breakout ahead of these results. I mean, expectation that you're going to see revenue reaccelerate here in their new fiscal year, and perhaps even come in stronger than that for Q1. How do you see it?
The black leather jacket's getting ready for Wednesday because I think the street numbers still are underestimated. We think anywhere from 15 to 20% over the next few years because everything we've seen from our checks in Asia, from Taiwan, show demand and supply 10 to 1 for NVIDIA chips. You've seen it from AMD, TSMC, just go across sort of the food chain. And I think this is really going to be another breakout moment relative to the AI trade. I think investors are still, especially when it comes to physical AI, think about the China trade, you know, when you think about H200s, that's not factored in. And look, the godfather of AI speaks. You'll hear a pin drop on trading floors because that is the most important thing in this market.
Right from the beginning of the conversation, the host challenged Dan Ives on whether this entire AI-driven tech rally has become overstretched. That is the question everyone wants answered right now because when you look at how much companies like Nvidia and the Nasdaq have already run, it feels almost irrational at times. But Dan Ives immediately shifts the conversation toward Nvidia earnings, basically saying that Nvidia continues to be the heartbeat of this entire market. In his view, the upcoming earnings report is not just another earnings event. He sees it as a major catalyst that could pour even more fuel onto this AI rally. And honestly, I think that point is extremely important because whether people want to admit it or not, this market right now is heavily dependent on AI enthusiasm. Every major tech stock rally today somehow connects back to AI infrastructure spending, whether it is chips, cloud computing, data centers, cybersecurity. software automation, robotics, or even industrial manufacturing, AI has become the narrative driving capital allocation across Wall Street. Dan Ives says they still expect tech stocks to rise another 10 to 12% for the rest of the year, even after this massive run. Now that might sound overly bullish to some people, but the reasoning behind it is what caught my attention. He repeatedly emphasizes that investors are underestimating how early we still are in this AI cycle. He compares the current environment to being in the top of the third inning with one out. In other words, he believes the game has barely even started, and this is where I personally think investors need to separate short-term volatility from long-term structural trends. Because yes, the market absolutely feels overheated at times. We have seen massive moves in semiconductor stocks. Valuations are stretched. Retail investors are piling into anything AI-related. But at the same time, when you look underneath the surface, corporations around the world are still only beginning their AI spending cycles. Most enterprises are still experimenting with AI deployment. Governments are still investing in infrastructure. Data center demand continues exploding. So while prices may pull back in the short term, the long-term secular trend still appears very real. Dan Ives also talks about these so-called white-knuckle moments that investors are going to experience along the way, and I actually appreciated that part because he is not pretending this market is risk-free. He mentions geopolitical tensions, interest rates, and fears surrounding potential policy changes from the Federal Reserve. Specifically, he references concerns about Kevin Warsh potentially coming into a bigger role, and what that could mean for tighter monetary policy. What he is basically saying is that anytime investors fear higher interest rates, the bears temporarily come out of hibernation and scare people into thinking the rally is over. But according to him, those pullbacks continue getting bought because the AI narrative is simply too powerful right now. And if I am being honest with you guys, that has pretty much been the story of this market over the past couple of years. Every correction eventually turns into another buying opportunity because institutional investors do not want to miss the next leg of the AI revolution. That fear of missing out is incredibly strong right now on Wall Street. One thing that really stood out to me in this interview is how almost every conversation somehow circles back to Nvidia. It is honestly unbelievable how central this one company has become to the entire market narrative. Dan Ives literally refers to Jensen Huang almost like the godfather of AI, and you can tell that traders are hanging on to every word that comes out of Nvidia right now. When the discussion shifts toward Nvidia earnings expectations, Dan becomes even more bullish. He says Wall Street is still underestimating the numbers and that demand for Nvidia chips is still massively exceeding supply. He references their supply chain checks in Asia, specifically mentioning Taiwan, and says demand is running 10-to-1 relative to supply. Now think about how insane that statement actually is. A 10-to-1 demand imbalance means companies around the world are scrambling to get access to AI computing power. That includes cloud providers, governments, startups, autonomous driving companies, robotics firms, healthcare AI systems, and pretty much every industry trying to integrate generative AI into their operations. And this is where I personally think many investors still fail to understand the scale of what is happening. Most people look at Nvidia and think it is just another semiconductor company, but in reality, Nvidia has become the picks and shovels provider for the AI gold rush. Every major company trying to build AI systems needs computing infrastructure, and Nvidia currently dominates that ecosystem. Dan also mentions AMD and TSMC as part of the broader AI supply chain, which is another important point because the AI boom is not isolated to one company. Entire ecosystems are benefiting from this spending cycle. Advanced Micro Devices continues pushing aggressively into AI accelerators. Taiwan Semiconductor Manufacturing Company remains critical because it manufactures many of these advanced chips. And then you have companies involved in power systems, cooling, networking infrastructure, industrial equipment, and data center construction, all benefiting as secondary AI plays. One thing I found interesting is how the hosts bring up geopolitics and oil prices, asking whether the market is becoming too complacent about risks in the Middle East and rising energy costs. This is where Vance Howard enters the conversation with a slightly more cautious tone. While he agrees that the AI trade is still alive, he also warns that rising treasury yields and inflation could become a serious issue. And honestly, I think this is probably the biggest risk that AI bulls are underestimating right now, because if inflation starts re-accelerating due to higher energy prices, then the Federal Reserve may have to keep rates elevated for longer than expected. And high rates are traditionally not great for high-valuation growth stocks, so even though AI fundamentals may remain strong, the macroeconomic backdrop could still create major volatility. Vance Howard specifically points to the 10-year Treasury yield rising over recent weeks and questions whether inflation might not be as transitory as some people hoped. That comment really matters because markets have been pricing in eventual rate cuts and easier monetary conditions. But if inflation stays sticky due to energy costs or supply constraints, then the market may need to adjust those expectations. Personally, I think this is the tug-of-war investors are dealing with right now. On one side, you have arguably the most transformative technological shifts since the internet boom. On the other side, you have concerns about affordability, inflation, interest rates, and economic pressure on consumers. And the market is basically trying to figure out which force is stronger. Another thing I found fascinating is how both Dan Ives and Vance Howard almost welcome pullbacks at this stage. Neither one of them seems particularly worried about a 3 to 5% correction. In fact, they view it as a buying opportunity. That mentality alone tells you how bullish institutional investors still are underneath the surface. They are not looking at dips as reasons to panic. They are looking at dips as inventory discounts. Vance Howard even says they have cash sitting on the sidelines waiting for opportunities to deploy into quality tech names. That is very important because it suggests there is still a lot of capital ready to chase this market higher whenever weakness appears. And honestly, we have seen this behavior repeatedly throughout the AI rally. Every time fear enters the market, buyers eventually step back in because nobody wants to miss the next move higher. Toward the end of the interview, the conversation expands beyond pure software and semiconductors into industrial AI infrastructure. They mention companies like Micron, Rocket Lab, and Cummins. I actually think this part of the conversation is extremely underrated because it highlights how broad the AI build-out is becoming. People usually focus only on the flashy names like Nvidia or Microsoft, but AI infrastructure requires enormous amounts of physical hardware, electricity, cooling systems, power generation, and industrial support equipment. For example, Cummins gets mentioned because massive AI data centers require backup power systems and heavy industrial engines. That may not sound exciting compared to generative AI chatbots, but it is critical infrastructure for the AI economy, and this is where I personally think the next phase of the AI trade could evolve. Early on, investors focused mostly on chip makers and mega-cap tech, but over time, the ripple effects may spread into industrial companies, utilities, energy infrastructure, cybersecurity firms, robotics, aerospace, and advanced manufacturing. That broader expansion could create entirely new winners that many retail investors are not even paying attention to yet. At the end of the day, the biggest takeaway from this interview is that Dan Ives remains overwhelmingly bullish on the AI revolution despite all the noise surrounding rates, geopolitics, inflation, and market valuations. He clearly believes this is not a temporary hype cycle but a once-in-a-generation technology transformation. Now, whether you agree with him or not probably depends on your view of how sustainable AI spending truly is. But one thing is undeniable: AI has completely changed the psychology of this market. Investors are no longer just buying earnings growth. They are buying future dominance in what many believe could become the defining technological shift of the next decade. And honestly, after watching this interview, I think it becomes clear why the market keeps climbing despite all the fear headlines. Right now, Wall Street appears willing to tolerate a lot of uncertainty as long as the AI growth story remains intact. Now let's break down the two AI stocks trading under $10 that could potentially become massive long-term winners as the artificial intelligence revolution reshapes entire industries over the next decade. The first company on this list is SoundHound AI, ticker symbol SOUN. Now, when most people hear the phrase artificial intelligence, they immediately think about chatbots, image generators, or large language models. But one of the most overlooked areas of AI right now is voice technology. And honestly, I think this could quietly become one of the most important parts of the entire AI ecosystem over the next decade. Because if you really think about it, voice is the most natural interface humans have. People do not want to constantly type commands into devices forever. Over time, humans naturally prefer speaking. It is faster, more intuitive, and far more scalable in environments where typing simply is not practical. That is exactly where SoundHound AI is positioning itself. SoundHound AI is developing conversational voice AI systems capable of understanding human speech and turning those interactions into actions. And what makes the company interesting is that it is not just trying to become another generic chatbot company. Instead, it is targeting very specific industries where voice AI can solve expensive operational problems. For example, SoundHound AI has been aggressively expanding into restaurants, automotive systems, healthcare, financial services, retail, and customer support operations. These are all industries where businesses handle massive amounts of repetitive customer interactions every single day. If AI can automate even a portion of those interactions efficiently, the cost savings could become enormous. One of the strongest examples is the restaurant industry. SoundHound AI's technology is already being used to take drive-through orders using conversational AI agents. Now, at first glance, that might not sound revolutionary, but when you really break it down, this is actually a massive opportunity. Restaurants struggle constantly with labor shortages, rising wage costs, inconsistent order accuracy, and operational inefficiencies. An AI system that can consistently handle orders accurately 24 hours a day without breaks becomes extremely attractive financially. And this is where I think many investors underestimate SoundHound AI. A lot of people still view the company as speculative because it is relatively small compared to larger AI players. But the real question investors should ask is this: if conversational AI becomes mainstream across restaurants, customer support centers, vehicles, and enterprise operations, who actually specializes in this area today? SoundHound AI has spent years building its voice recognition and speech-to-meaning technology. This is important because understanding language is far more complex than simply recognizing words. Human conversations contain accents, slang, interruptions, context shifts, and incomplete sentences. Building AI systems that can interpret real-world conversations naturally is extremely difficult. The company's proprietary technology focuses heavily on speed and accuracy, and according to management, their systems are designed to deliver responses in real time while understanding intent, rather than simply recognizing keywords. That distinction matters a lot, because the future winners in AI probably will not just be the companies with the biggest models. It may also include companies that develop highly specialized AI solutions for real-world enterprise applications. Another thing that makes SoundHound AI particularly interesting is its expansion strategy through acquisitions. The company recently made moves to strengthen its enterprise AI capabilities through acquisitions that expand its customer base and technological reach. One of the biggest developments involved its acquisition of Amelia, which significantly expanded SoundHound AI's presence in enterprise customer service and regulated industries like healthcare and finance. That acquisition gave SoundHound access to clients that require highly sophisticated conversational AI systems capable of handling industry-specific terminology and compliance standards. And personally, I think this was a smart move because enterprise AI adoption is likely going to accelerate significantly over the next several years. Companies everywhere are looking for ways to reduce costs, improve customer experiences, and automate repetitive workflows. AI agents that can interact naturally with customers may eventually become standard infrastructure for many businesses. What also stands out about SoundHound AI is the size of the market opportunity itself. Industry forecasts suggest that the generative AI-powered customer service market could expand dramatically over the next decade. Some projections estimate that by 2028, roughly 75% of new contact centers could involve generative AI technology in some form. Think about how massive that shift could become. Customer service is one of the largest operational expenses for businesses globally. If AI systems become capable enough to handle a growing percentage of customer interactions, the economic incentive for adoption becomes incredibly strong. And unlike some AI concepts that still feel futuristic, conversational AI is already happening today. Consumers are becoming increasingly comfortable interacting with AI systems. Businesses are already integrating voice assistants, automated ordering systems, AI receptionists, and conversational support tools into daily operations. That means SoundHound AI is participating in a market that is not just theoretical anymore. It is actively commercializing. Financially, the company has also been showing strong revenue growth. In recent quarters, SoundHound AI reported revenue growth of approximately 68% year-over-year. For a company still in expansion mode, that kind of growth rate naturally attracts investor attention. The company has also continued raising its full-year guidance as adoption expands across multiple industries. That is another important point because investors always want to see whether management's optimism actually translates into improving business performance. Now, obviously, this is still a risky stock. I want to make that very clear. SoundHound AI is not consistently profitable yet, and like many smaller AI companies, volatility can be extreme. The stock has experienced huge swings over the past couple of years. Some investors see it as a meme stock because retail enthusiasm can push the price aggressively in either direction. But personally, I think dismissing the company entirely because of volatility may cause investors to overlook the bigger picture. The reality is that many transformative growth companies look risky and unstable during their early scaling phases. The question long-term investors need to ask is whether the company is building something that could become materially more valuable over time. And in SoundHound AI's case, the long-term thesis is built around conversational AI becoming deeply integrated into daily business operations. Another thing that caught my attention is how diversified the company's customer base is becoming. SoundHound AI is not relying solely on one industry to survive. The company has exposure to automotive voice systems, restaurants, call centers, enterprise AI agents, and healthcare operations. That diversification could become extremely valuable if one vertical experiences slower adoption temporarily while others accelerate faster. The automotive side of the business is especially interesting to me because vehicles are becoming increasingly software-driven. Over time, voice-controlled systems inside vehicles could become standard rather than optional. Drivers naturally prefer hands-free interaction while driving, and AI voice systems could eventually control navigation, entertainment, vehicle diagnostics, customer support, and even commerce-related functions inside vehicles. If SoundHound AI successfully expands its footprint there, the long-term upside could become substantial. At the same time, investors absolutely need to understand the risks. Competition in AI remains intense. Larger technology companies are aggressively investing in conversational AI. There is also execution risk because scaling enterprise AI businesses requires significant investment, strong customer retention, and continuous technological improvements. Profitability is another major concern. While revenue growth has been impressive, the company still needs to prove it can scale efficiently while eventually generating sustainable profits. Investors should monitor operating expenses, customer acquisition efficiency, and whether management can continue improving margins over time. There are also concerns about potential dilution. Smaller growth companies sometimes raise additional capital through stock offerings to fund expansion, and that can pressure shareholders in the short term. So this is definitely not a low-risk dividend stock type of investment. This is a high-growth, high-volatility AI stock. But for investors with a long-term time horizon who believe conversational AI adoption will expand dramatically over the next decade, SoundHound AI could become one of the more interesting speculative growth plays in the market under $10. And honestly, one of the biggest reasons I think investors continue watching this company so closely is because the potential upside is difficult to ignore if execution improves over time. Right now, the company's market capitalization remains relatively small compared to what some investors believe the conversational AI market could eventually become. If SoundHound AI successfully captures even a modest percentage of that market opportunity, the business could look dramatically different 5 to 10 years from now. Another thing I think investors should pay attention to is how AI adoption itself is evolving. Early AI excitement focused heavily on infrastructure companies building chips and data centers, but eventually investors start searching for application layer companies that actually deploy AI into everyday business use cases. That shift could become extremely important, because over time, the companies creating practical AI solutions for real-world industries may become just as valuable as the infrastructure providers supporting the ecosystem, and this is where SoundHound AI's focus on practical enterprise deployment could potentially work in its favor. Instead of trying to dominate every AI category simultaneously, the company appears focused on becoming highly specialized in conversational intelligence and voice-driven enterprise automation. If management executes successfully and adoption continues scaling, SoundHound AI could potentially emerge as one of the more important voice AI players in the market over the next several years. Now, does that guarantee success? Absolutely not. This remains a speculative investment with substantial risk. But when investors search for AI stocks under $10 with long-term upside potential, they are usually looking for businesses operating in massive future markets before the broader market fully prices in the opportunity. And SoundHound AI fits that profile. It is participating in a rapidly growing industry, building technology that solves real operational problems, expanding across multiple verticals, and generating strong revenue growth while still remaining relatively small compared to many larger AI names dominating headlines today. That combination is exactly why so many long-term growth investors continue paying attention to SoundHound despite all the volatility surrounding the stock. Because if conversational AI becomes as deeply integrated into the economy as many analysts expect, companies specializing in that infrastructure could become significantly more valuable over time. And honestly, I think that is the core investment thesis here. Not short-term hype, not meme stock momentum, but the possibility that voice-driven AI interactions eventually become a normal part of everyday business operations across multiple industries worldwide. If that future plays out, SoundHound AI could potentially be sitting in a very powerful position years from now. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second AI stock under $10 that could potentially deliver significant long-term gains is Aurora Innovation, ticker symbol AUR. Now, this company operates in a completely different corner of the AI economy, but in my opinion, the long-term opportunity here could be absolutely enormous if the technology reaches large-scale commercialization, because Aurora Innovation is not focused on chatbots, voice assistants, or customer service automation. This company is trying to fundamentally transform transportation itself through autonomous driving technology, and specifically, Aurora is heavily focused on self-driving trucking. Now, at first, some people hear autonomous vehicles and immediately tune out because the industry has faced years of delays, hype cycles, technical setbacks, and investor disappointment. But honestly, I think that skepticism is exactly why some long-term investors are still watching Aurora so closely right now while the stock trades under $10. Because despite all the noise surrounding autonomous driving over the years, the economic incentives behind autonomous trucking are still incredibly powerful. Think about the trucking industry for a second. Global supply chains depend heavily on freight transportation. Trucks move enormous amounts of goods across countries every single day, but the industry faces constant challenges including driver shortages, rising labor costs, fuel inefficiencies, delivery delays, and safety concerns. Now imagine a future where autonomous trucks can operate for much longer hours, reduce accident risks, improve fuel efficiency, lower operating costs, and move freight more consistently across long distances. That would completely reshape the economics of transportation and logistics. And Aurora Innovation wants to become one of the companies helping make that future possible. What makes Aurora particularly interesting is the company's focus on freight trucking first, rather than immediately trying to dominate consumer robotaxis everywhere. Personally, I think this strategy makes a lot of sense because long-haul trucking routes are often more predictable and structured compared to complex urban driving environments filled with pedestrians, cyclists, unpredictable intersections, and dense traffic conditions. In other words, autonomous trucking may actually become commercially viable faster than fully autonomous personal transportation in many cities. Aurora's core technology platform is called the Aurora Driver. This is the company's self-driving system designed to navigate vehicles autonomously using a combination of sensors, cameras, radar, LiDAR technology, machine learning models, and real-time AI decision-making. The company has spent years testing and refining these systems in real-world driving environments. And one thing investors should understand is that autonomous driving is not simply about getting a vehicle to move from point A to point B. The real challenge is handling the endless number of unpredictable edge cases that happen constantly on roads. Construction zones, weather conditions, aggressive drivers, road debris, unexpected lane changes, emergency vehicles, low visibility conditions, animals crossing highways. All of these situations require rapid decision-making capabilities, and that is where AI becomes absolutely critical. Aurora is essentially building AI systems capable of interpreting massive amounts of environmental data in real time while making safe driving decisions under constantly changing conditions. That is an incredibly difficult technological challenge. But if companies eventually solve it at scale, the economic implications could be enormous. One thing I personally find fascinating about Aurora is how directly tied the company is to the future growth of AI-powered automation in the real-world economy. A lot of AI discussions today focus mainly on software productivity tools, but autonomous transportation represents physical world AI deployment on a completely different level. If self-driving freight networks eventually scale successfully, the ripple effects could impact logistics costs, e-commerce delivery speeds, supply chain efficiency, labor dynamics, fuel optimization, and even inflation itself over the long term. And this is why Aurora remains such an interesting speculative AI stock despite all the uncertainty surrounding the sector. The potential market opportunity is massive. Aurora has also been working with major industry partners to help commercialize its autonomous trucking systems, Partnerships matter tremendously in this industry because deploying autonomous freight systems requires collaboration across vehicle manufacturing, logistics infrastructure, freight operations, and regulatory compliance. The company has focused heavily on building relationships that could eventually help integrate its technology into commercial freight operations at scale. Another thing investors should understand is that autonomous trucking is not necessarily an all-or-nothing business model. Even incremental improvements in freight automation could create meaningful value. For example, autonomous systems might initially operate primarily on long highway routes between major logistics hubs while human drivers handle more complicated urban delivery segments. That hybrid approach could still improve efficiency significantly while reducing operational challenges. And honestly, I think that is probably how this industry evolves over time, not overnight disruption, but gradual integration, one route at a time, one logistics corridor at a time, one commercial partnership at a time. Now, financially, Aurora remains very much a high-risk growth company. The business is still in development mode, which means profitability is not the current focus right now. Instead, the company is investing heavily into technology development, testing infrastructure, AI training systems, and commercialization efforts. That means investors need to understand clearly that this is a speculative investment. Revenue generation today is still limited relative to the scale of the long-term vision. The company continues burning cash while developing its autonomous driving ecosystem, which naturally creates risk for shareholders. But again, this is often the reality for companies trying to build transformational technologies years before full commercialization occurs. The important question becomes whether the company is making measurable progress toward real-world deployment. And recently, Aurora has continued moving closer toward commercial launch milestones in autonomous trucking operations. That matters because one of the biggest concerns investors always have with autonomous driving companies is whether the technology will ever actually leave the testing phase and generate meaningful real-world revenue. Aurora appears focused on proving practical deployment rather than simply making futuristic promises, and personally I think that distinction is important, because markets eventually stop rewarding hype alone. Investors want evidence of execution. Now, another reason I think Aurora remains interesting under $10 is because of how large the autonomous trucking market could eventually become if adoption accelerates. The trucking and freight industry represents a multi-trillion-dollar global market. Even capturing a relatively small portion of that ecosystem could create enormous revenue opportunities over time. And unlike some AI applications that consumers may or may not adopt enthusiastically, logistics companies have very strong financial incentives to improve operational efficiency. If autonomous trucking systems can eventually reduce costs materially while improving delivery reliability and safety, adoption pressure could become significant across the industry. Of course, there are still major obstacles ahead. Regulation remains a huge factor. Public safety concerns remain a huge factor. Technological reliability remains a huge factor. One major accident involving autonomous systems can quickly shift public sentiment and regulatory scrutiny. That is why companies like Aurora must move carefully and prioritize safety above everything else. And honestly, I think the companies that survive long-term in autonomous transportation will likely be the ones that scale more cautiously and responsibly rather than rushing deployment for headlines. Competition is also intense. Autonomous driving remains one of the most competitive areas in AI and transportation technology. Multiple companies globally are investing billions trying to solve these problems. That means Aurora not only needs technological progress, but also strong execution, capital management, and strategic partnerships to remain competitive over the long term. There is also dilution risk investors need to watch closely. Like many development stage technology companies, Aurora may require additional funding over time to continue scaling operations before achieving sustainable profitability. That could pressure shareholders if additional shares are issued in the future. So again, this is absolutely not a low-risk investment, but the reason some long-term investors remain interested is because the upside scenario could become extremely large if autonomous trucking eventually reaches widespread adoption, and this is where I think people need to think probabilistically rather than emotionally. Not every speculative AI company will succeed, some will fail completely, but occasionally, one company operating in a transformative future industry scales into something much larger than anyone initially expected. That is what speculative growth investing is really about. Finding businesses with asymmetrical upside potential before the broader market fully recognizes the long-term opportunity. And Aurora fits that category. It is attempting to solve an enormous economic problem using advanced AI systems, in an industry where even moderate success could create substantial long-term value. Another thing that stands out to me is how autonomous transportation connects directly to broader macroeconomic efficiency trends. Governments and businesses everywhere are focused on improving supply chains, reducing costs, increasing productivity, and modernizing infrastructure. Autonomous freight systems align closely with many of those long-term economic objectives, and over time, as AI models improve, sensor technology advances, and computing power becomes more efficient, autonomous systems could gradually become more reliable and commercially scalable. That progression may take longer than investors initially hoped years ago, but the underlying economic incentives still remain incredibly compelling. I also think many investors underestimate how patient transformational technologies often require. The internet took years before becoming deeply integrated into daily life. Cloud computing took years before widespread enterprise adoption accelerated. Electric vehicles faced skepticism for years before scaling meaningfully. AI-driven autonomous transportation may follow a similarly long development curve. That means investors considering Aurora need to think in terms of years, not weeks. This is not really a short-term momentum trade thesis. This is a long-duration technology adoption thesis. If autonomous trucking eventually becomes commercially mainstream over the next decade, companies successfully positioned in that ecosystem today could potentially look very different financially years from now. And because Aurora still trades at relatively low levels compared to some larger AI names dominating headlines, speculative investors continue watching the company closely for signs of commercial progress. Now personally, I think Aurora is probably one of the more fascinating high-risk AI plays, simply because the upside scenario is so large if execution improves over time. But again, the risks are substantial. This is a company operating in one of the hardest technological fields imaginable. Investors need patience, risk tolerance, and realistic expectations. There will likely be volatility. There will likely be delays. There will likely be periods where market sentiment swings aggressively in both directions. But if autonomous trucking eventually scales meaningfully, Aurora could potentially emerge as one of the more important players in that future ecosystem. And that is why some investors continue viewing AUR as one of the more intriguing speculative AI stocks trading under $10 today. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. When you step back and look at both of the companies discussed in this video, what becomes really interesting is that they are approaching the AI revolution from completely different directions. SoundHound AI is focused on conversational intelligence and enterprise automation. Aurora Innovation is focused on autonomous transportation and logistics transformation. But both companies share one important thing in common. They are trying to solve real-world operational problems using artificial intelligence. And honestly, I think that may become one of the biggest themes of the next decade. The winners in AI may not just be the companies building giant models behind the scenes. The winners could also include the companies successfully applying AI technology to industries where efficiency improvements create massive economic value. Now the question becomes, which approach has the stronger long-term competitive advantage? Will conversational AI become more deeply integrated into everyday business operations faster than autonomous transportation scales commercially? Or could autonomous freight systems eventually create even larger economic disruption over the long term? That is the question I want you guys to answer in the comments below. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.